Hi everyone. In this video, as promised, we are going to take a look at the income statement, and we are going to build the income statement based on the previous transactions that we recorded. If you haven't seen the previous videos, I highly recommend it because it's building on top of each other, starting with journal entries, closing entries, the balance sheet, and now we are going to look at the income statement. So with that said, let's take a look at the revenues. We are going to look at the journal entries, and we are going to see that the only revenue that we have recorded was a credit sale in transaction number 2. So that's what we are going to record. This is, in this particular example, their only revenue source. And then we have cost of goods sold. All the expenses are going to be negative. We have cost of goods sold, and we recorded cost of goods sold in the closing entries. So as you may remember, transaction number 3 says the inventory is decreasing from 5,000 to 4,000, which is a decrease of 1,000. So this is cost of goods sold. It's reducing retained earnings. And then we have the wages expense. Let's write that here. The wages expense is also under closing entries. We realize that we haven't paid certain wages, so we are going to record it as such. It's going to be again negative. Then we have rent expense. As you may remember from the previous video, we recognize the rent expense under closing entries. We are going to record that as a negative. Then we have depreciation expense. We will again go back to our closing entries, and we are going to locate the depreciation expense. It turns out it was negative $600. And then we have the last expense item we have is the interest expense. Again, under closing entries, we have the interest. So we are going to take a look at that. It is negative $400. This is the interest expense that we have, and we are going to record it as such. And when we take the sum of these, we are going to find the income before taxes. And then we have tax expense that's also captured in the closing entries. So let's take a look at that. This is our tax expense right here from the previous videos, and I'll also post this, as I mentioned earlier, this spreadsheet, so you can play with it as well. And now we can calculate income before taxes and tax expense. So our net income turns out to be $3,000. And I want to also briefly mention retained earnings piece. The company started operations at the beginning of this period, so retained earnings beginning was actually 0. Then we have net income. A profit is going to increase retained earnings. And then we are going to have dividends. Whether they are paid or not, it doesn't matter. By the time we declare them, we need to recognize it. So we are going to look at dividends. That's going to reduce our retained earnings. And then we are going to calculate retained earnings ending. The beginning balance, since it started operations new, it's 0, plus the profit minus the dividends. That's going to give you the ending retained earnings. And if you remember from the previous video on the balance sheet, it was 1,500. This is another way to find that 1,500 retained earnings as well. So they both match, and this is pretty much the end of our analysis of the hypothetical company ABC Inc. I hope that it gives you a good insight into how to record transactions, how to close the entries, how to build the balance sheet, and eventually how to build the income statement.